Good day, everyone, and welcome to M&T Bank's Understanding What's Important. So this is targeted to our mentor cohort program and our mentor cohort in the DC metro area. I want to introduce you all to Emily. Emily and M&T Bank are sponsors for the DC metro area cohort, as well as Emily is one of our senior fellows, a specialist in banking and finance. And today we're going to have Emily kind of give us an overview about all things finance. Is that correct, Emily?
That's correct, Marie.
Okay, great. And so Emily's going to share her pearls of wisdom in the world of finance. And so I'm going to kind of go into stealth mode, Emily. I'm going to turn off my mic and I'm going to turn off my camera and I'm going to let you just dazzle us with these amazing things, all finance related.
Sounds great. Thank you, Marie, for the very kind introduction and for the opportunity to support the cohort and NVSBC. We're really grateful for that. So as you mentioned, today we will be discussing all things banking and financing. So a really interesting topic in the government contracting world, because we all know that you GovCons can win a large contract and double, triple, quadruple in size overnight. So it's really important to make sure that you have everything lined up in the conversation with your banker and on the finance side, so that you're set up in a way that you can say yes to that next opportunity. So we will get right into it. But before that, I will give a short introduction and background of myself. So as Marie mentioned, my name's Emily Basile, and I'm with M&T Bank. I'm a senior relationship manager in our government contracting group. So specialize in government contractors, anywhere from starting out to about 50 million in annual revenue. And then we have a GovCon specific team at M&T Bank on the middle market side that takes over from there. So been with M&T for a little over 11 years now. Absolutely love it. Love working hand in hand with the government contractors throughout their life cycle to set them up for success. And I like to call myself entrepreneurial adjacent, to the brave souls that have started their own business here. So as I mentioned, work for M&T Bank, and I'll give you guys a little bit of background and context about M&T. So we were founded back in 1856 in Buffalo, New York. We have 19 community banking regions spanning from Maine down through Richmond, Virginia on the East Coast. And myself and my group primarily concentrate on Virginia, Maryland, and DC, but have counterparts in those other community banking regions that can certainly help as resources as well. So M&T, you probably heard us from M&T Bank Stadium, the Ravens Stadium. We call Baltimore our second headquarters of sorts, but we are a top 15 bank. We are super regional bank, so we have the resources of the large banks, but we still really pride ourselves on the community feel, and that we're working face-to-face, hand-in-hand with our local communities and our local government contracting executive teams. All right, for today, we are going to go through a few different topics. First of which is what you should expect from your banker. Second, how the banking setups for government contracts are typically set up. Next, we're going to go through some credit considerations, as well as some key ratios you'll want to take a look at. And then lastly, we'll wrap it up with talking about different types of financing, traditional versus SBA, and then some questions that you should keep in mind as you're evaluating your relationships and your strategy. So first, what you should expect from a bank and your banker. So a few things here. First, you really want to be having proactive meetings versus reactive meetings with your banker. And that cadence can be really specific to what's going to work best for you and your business and what life cycle you are, at what point in the life cycle you are in. So perhaps in certain points it makes sense for a quarterly cadence. Other times when you're in high growth mode, maybe you're meeting month to month. or perhaps even more when there's you've just won a new contract and you're really making sure that you're set up for success on the financing side. But really the bottom line is just to make sure that there's open communication between you and your banker so that you can quickly pivot as different things come across and be prepared for them. Next, the banker should really be getting to know you and the way that you're doing business and pairing your needs with product and solution recommendations that are going to make your life easier and are going to help you grow. So those products and solutions should really be specifically tailored to the way that you're doing business. Next is introductions to other service providers. So we all know how unique the government contracting industry is. It's particularly important that your service providers understand GovCon because of those industry intricacies. So if you have some service provider partners that might not specialize in GovCon, and perhaps they were good when you started out, but now you're a bit further along and you really need that specific knowledge, your banker should be someone that you can go to ask for specific introductions. They have a wide client book, and a lot of times we're asking our clients, do you highly recommend your CPA? Do you highly recommend your insurance broker or your attorney? So we have an arsenal of people that we know do a good job. Next is business development activities. So your banker should really be part of your business development team. Again, they have a portfolio of clients, and we all provide those boring banking solutions, but where we can really add value and differentiate the relationship is if we're able to make a pinpointed introduction to another GovCon, for example, that might be your next teaming partner. We're able to invite you to an event where GovCon's targeting a specific agency are all getting together to share best practices or meet government personnel. Lastly, I mentioned this before, but the bank and banker should really understand your industry and be able to offer you solutions based on that. For example, what comes to mind for GovCons is winning the new contracts quickly. Things can change. So a lot of times when we're assessing requests, we're looking at the contract backlog, we're looking at projections, and we're listening to your story so we can advocate for you. And the GovCon knowledge is important for that. So in these regular conversations with your banker, you might be thinking, what does my business need? How should I be set up, and how can I make sure that I am getting the most out of my relationship? So I'll run through our typical GovCon banking relationship. First, they're going to have a checking and usually a savings account or an investment sweep. We are in a high interest rate environment still, so taking advantage of any excess funds, earning some extra interest certainly is not a bad idea. Next is fraud protection. Unfortunately, we've also seen as of late an uptick in fraud, can be ACH, check fraud, etc. So making sure that you have the right services in place that are protecting your hard-earned money is definitely worth the conversation. Next, sending and receiving money. So you should be set up to make the way that you're doing business seamless. ACH, wires, some people send checks. For the fraud protection that I just mentioned, it's best to not send so many checks. So the more that you can be set up to send payments electronically, the better. Next is purchasing card. This is your corporate credit card. This is really helpful if you're already making purchases to be able to get money back for your spending. So, and also if you have different employees that need employee cards, helps you have the protections in place on those cards so that you can distribute it accordingly. And then next, most of my GovCons, they'll have a line of credit. So that line of credit largely is remaining at a zero balance for most of the year. And then we'll see, they've won a new contract. So there's a month or two where they've advanced from that line of credit while they're staffing up before the AR starts to stream in. And then once that AR is received, they're paying it back to reduce any interest expense that they'd have to be paying on an outstanding balance. Next is term loan. We'll see the uses, typically M&A financing. So when our clients are looking to buy other companies and are looking to leverage some bank debt in addition to cash they might be putting into the deal, or equipment purchases. And then lastly, commercial mortgages. This is a little bit less frequent on the GovCon side because we have a lot of people that are working chiefly remotely, or maybe they have a flex space that they're using just for meetings. But it can be an interesting strategy for the overall value of your company and your portfolio to have some real estate involved. So from time to time, we will see GovCons looking for commercial mortgages, whether that be owner occupied or investment real estate. So we talked through a few different credit facilities that you might need within your business life cycle. But when you need that credit, what is the bank going to be looking at? So to give you a peek behind the curtain, we call it the 6 C's of credit. These are the major areas that your banker is going to be advocating for you, explaining the story to the underwriter for them to look at to evaluate a credit request decision. First is character. So that goes to, is there integrity of the borrower? Speaking to the veteran-owned small businesses and NVSBC, the fact that you're a veteran, you have that experience behind you, speaks worlds to your character. So make sure you let your banker know that, and that is definitely a great point to integrity. But also we'll look at your willingness to pay, and with that comes, if there's a personal guarantor for the loan, we'd be looking at personal credit scores. So not only is your business paying its debts, but are you personally also paying your debts in a timely manner? Next is capacity, which is cash flow. So that is essentially your ability to repay on the loan. We'll look at that on the business side, and again, in cases where there's personal guarantors involved, we'll look at that globally as well. We'll look at historics, as well as if it's a high growth situation, we'll also look at projections. In the next slide, we're going to get into some key ratios that you'll want to keep in mind as well to the cash flow standpoint. Before we do that, the third C is capital. Capital is a borrower's investment in a business or project. So if you take the example of an M&A loan, so when you're looking at an acquisition, perhaps you're putting in some of your own cash out of pocket so that you have skin in the game into the investment. So beyond that, we'd also look at, is there financial strength both on the personal and business side, so that after the transaction occurs, do you still have some money in your account at the end of the day? Whereas if there's business fluctuations and you need a little bit of excess cash flow, you're able to leverage that and you're not deploying all your capital to not have any reserves is one point we'll look at. Next is collateral. So in the GovCon world, this is primarily going to be your AR and your deposits, right? A lot of our GovCons are service-based. They don't have hard assets. So those are, if we're looking at a line of credit, do they have the AR to back that up, for example? But if you are looking at real estate, the real estate itself is definitely going to be collateral there. So in those cases, we'll look at the value of real estate and we'll lend a specific amount based off that as well. Next is conditions. You guys are lucky in that your customer is the best payer in the United States, and that being the government. So despite macro and microeconomic conditions, the fact that you are providing services to the federal government is always a positive in that respect. But maybe depending on the political landscape, maybe there are certain agencies that, depending on what side of the aisle that you're on, maybe they're receiving more funding or not. But generally in the DoD space, there's a good level of comfort there despite the environment. And then lastly, this is my favorite one, common sense. So looking at all of this, there might be some weaknesses and strengths in different categories, but at the end of the day, would I lend my own money to this company? So if you take a step back and look at your own company and say, all right, if I were an outside observer, would I lend my money to this company? That can be a good pulse check and say, all right, there might be a couple of weaknesses, but there's strengths and mitigants that makes this overall request that makes sense. And that's really where your banker comes in. They're advocating for you. They're telling your story and working collaboratively to provide that to the underwriter. All right, so to dig back into the cash flow, here are some key ratios that your banker is going to be evaluating. You guys don't need to know how to do all these ratios. Again, this is going to be something that your banker can explain to you. And if there's adjustments that need to be made within your operating cycles or the way that you're growing or doing business, this is something that you guys can speak about in your quarterly or your monthly or your semi-annual meetings. So first is debt service coverage ratio. I like to explain this one as, at the end of the day, for every dollar of debt, you're going to want to have about $1.20 to $1.25 of income in order to pay that debt. So you're able to pay the debt, but you're also able to have a little bit of a buffer in case there are, contracts lost or things don't go as expected and you need a little bit of extra cash buffer. We never want to put a business in a bad situation by over leveraging them. So the debt service coverage ratio is your net income plus your depreciation and amortization plus interest minus taxes or distributions divided by your debt service. Again, this can be measured on the business level. We can also take into account the individual picture to look at it globally. Next is the debt to income ratio. This comes into account more on the personal side if there are personal guarantors, and that's total annual debt payments that you have personally divided by your gross annual income. Typically around 36% to 43% is industry standard. So if you have a lower ratio, meaning that you have a lot more income than your debt payments, that tells us, all right, there's a lot of discretionary income here that can serve as a buffer, again, in case things don't go exactly as expected. Next is loan to value ratio. This one's going to be most important in real estate purchases or sometimes if there's acquisitions as well. And that's going to be the amount of the debt divided by the asset value. The loan to value, or we call it LTV requirements, are going to vary by the type of asset being purchased. So for example, if it's real estate that you're going to be occupying and using yourself, maybe we're looking at an 80% ratio, whereas if it's very specialty property, maybe it's a little bit lower. So that's something, if you have a property in mind, you can talk with your banker and see how they would view that on their side. The next ratio is current ratio, which is the working capital ratio. This is current assets divided by current liabilities. And what this means is you want to have more assets than liabilities. A ratio over 1-to-1, it means that a company can meet all of its current obligations within a year using only current assets. And we benchmark this based on industry. So for example, if you're IT consulting focused, industry average is more around 1.5 times plus. So talking with your banker, you can kind of figure out where you would ideally be, and you can help target that within your cash cycles. Last is debt to equity ratio. Now, this is the total liabilities divided by shareholders' equity minus intangible assets. So if you have if you're putting large amounts of debt on the books, and that usually being in the GovCon space, that usually takes place in an acquisition, we'll look to make sure that we're not over leveraging you, right? So that's going to that's a balance sheet ratio, but you'll also take into account the ability to repay through the debt service coverage ratio that we explained before. Bank standards on this can vary based on industry and economic conditions. So you'll hear me say it again, talk to your banker if you identify an opportunity, help you zero in to see if it makes sense, if it's within your purchasing power, and whether taking on that debt is going to put you in an okay position based on your financials. All right, so we talked about a lot of different ratios, and that's really what we're going to be looking at in a credit request. So if you are presenting an opportunity to your banker, or you're talking about a line of credit increase, et cetera, you don't need to know exactly how the loan is going to be structured at that very moment. The banker can take a look at everything and make recommendations. And a big one of those is whether it's going to be financed traditionally through conventional bank lending or through SBA loans. The SBA loan benefits are numerous. It's a wonderful tool that bankers have in their tool belt. So I'll take the example of M&T. So if M&T is helping you out with an SBA loan, M&T is still the one lending you money, but in a default situation, if you weren't able to repay on the loan and it had to default, the SBA provides an insurance policy of sorts to the bank. So in the Express program, for example, if there's $100,000 that's defaulted, the SBA is going to be responsible for 50% of that being $50,000, and M&T would be responsible for 50% being the remaining $50,000. So it decreases M&T's exposure, which allows us to be a little bit more flexible in some of the terms and the way that we're looking at things. So one, it's great for startup entities. So with traditional lending, usually we're looking at historical financials, which can be supplemented by projections, but we're really using history to inform part of the picture. When you're a startup, of course, you don't have those historical financials yet. You only have projections. And if you've been lucky enough to be awarded a contract, you can really flesh those out. With the SBA loans, we can take a look at 3 years of projections and zone in on what line of credit is going to support that growth. Another major pro is the reduction of required down payment. If you take an M&A loan, for example, if you're going for a traditional bank financing, typically we're looking at about 20% of the total purchase price being put down from cash out of your pocket. However, if you go the SBA route, that's lowered. So it could be 10%, or in sometimes even lower when there's a seller note involved, because there can be consideration for some of the seller note to count towards your equity injection. So a lot of creative flexibility that can make these acquisitions more affordable. Next, longer maturity than conventional loans. Generally, we'll see, for, again, using M&A as an example, maybe 5-7 years max for the term length. Whereas with SBA, you can go out to as long as 10 years, which gives some more flexibility. And to that point, there's also no prepayment penalties. So if you're taking on a longer maturity, but you're killing it and you have all this excess cash flow and you want to reduce the dollar amount of your exposure to save interest expense, you're able to do that without a penalty. Next, there's multiple programs. You can get lines of credit, you can get SBA 7A loans for term debt, and you can do combinations of the different programs up to $5 million in total exposure. It's been $5 million for a while now. There's been talks about that increasing at some point. So it will be interesting to see what the next few years hold for that number. Next, broad definition of small business. So although SBA says the loans need to be made to small businesses, what is considered a small business is really dependent on the NAICS code. So helping out one of my other clients look at an M&A deal right now, and with their NAICS code, as long as they're under 30 million in revenue, they're eligible for SBA financing. So something that you can look up on the SBA website to figure out where you would fit there. And finally, flexible use of proceeds. We talked about working capital. That can be permanent through a term loan or revolving through a line of credit. Business acquisitions, debt refinancing, leasehold improvements, and you can also use SBA loans to acquire land and equipment. or purchase or improve a building. So really a lot of different uses. And again, just a really valuable tool in the tool belt when SBA financing makes sense. All right, so we went through a lot today, and I tried to narrow it down to a few bullet points questions that you can ask yourself to reflect, but as well as discuss with your banker in order to make sure that you're set up for success. So first, do you have enough working capital for bridging AR and AP, emergency purposes, covering payroll, etc.? A lot of you in the audience might be thinking, all right, she's getting at a line of credit here, and you would be correct. So do you have something to buffer, if you're winning a new contract, so you can say yes to that opportunity and be able to scale up quickly? It's definitely an important question and an important thing to have available to you. Next, when's the last time you reviewed your bank's services and fees? When you started out, maybe your business had $1,000 to its name, and now you're 5 years down the road and you've multiplied that, a millionfold, and you're at 500,000 in cash, and you have various loan facilities. Things can change within the bank, but as well as based on the services that you're now needing on a larger scale and the amount of money that you have in the bank, there might be some different accounts that are more advantageous for you, both cost-wise and ease of business-wise. So always good to revisit that at least on an annual basis. Next, are you protected against fraud? I spoke a little bit to this earlier, but I wanted to re-emphasize it here. As a banker, we see too many horror stories. So when you're sending wires, please make sure you're verbally confirming everything, but also make sure that you have those back protections in place, whether that be ACH monitor solutions for ACH fraud or positive pay solutions for check fraud. Definitely worth a conversation. Next, what's your strategy for growth? Where do you want to be? Do you want to grow organically? Do you want to grow by acquisition? Great things to reflect on yourself, but then also communicate to your banking partner and other service providers. And then finally, what are your plans for 1, 3, and 5 years out? And what's your exit plan? Do you want to sell the company? Would you like to sell it to a current employee? Is there a competitor that maybe you would sell it to, or a private equity firm? Or do you want to, work 10 years down the road? All these things, and kind of reflecting on that game plan is really important to be able to know when to involve the right people at what points in time. All right, so we will finish it out with some resources. So the first one goes without saying, NVSBC is a phenomenal resource. I've been blessed to be a part of the organization for 3 years now, and I've firsthand seen the impact that it can have on small veteran-owned businesses in my own client portfolio. So definitely great to continue to get involved and really leverage this wonderful resource that we have in our backyards. Next, SBDC and SCORE are both phenomenal resources. When you're starting out or in your high growth mode, they can help you with things like crafting a business plan, crafting projections, or just general strategizing. Next, the SBA website. I talked a lot about the different programs that they have available that are wonderful resources, and that link there will bring you to exact definitions of the programs in case you're curious to learn more. And finally, your trusted advisors are huge resources to you. Your CPA, your business attorney, your insurance provider, your financial advisor, commercial realtor if you're interested in the real estate world, and finally, your banker and lender. All these advisors should be working in lockstep with you and also in lockstep with each other. So are they communicating? Do they have GovCon expertise? And are they working hand in hand to help you realize your goals? And with that, just wanted to say thank you so much for the opportunity to present today. And I am more than happy to have one-on-one conversations and delve into your particular situations, whatever I can do to help, and just appreciate being here today. Thank you so much, Marie.
Thanks, Emily. That was that was a wealth of information. I really appreciate you going over that in great detail and sharing those pearls. With that, I'm going to call it a wrap, and this will be available to the mentor cohort communities of interest once we get it up and posted to our website. And so look for Emily at the DC metro area dinners, right, Emily? You do come.
Yes.
You do come to those as well. So you can go ahead and say hello to Emily. And I'm going to say ciao for now, and stay tuned. There will be more from M&T Bank in upcoming Charlie Mike sessions as well.